ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. The ETF business is bigger than ever, and it's getting more global. Let's talk with John McKenzie. He's the CEO of TMX Group, which owns the Toronto Stock Exchange and just made a major acquisition in the ETF space. John, thanks for joining us. You have been a leader in the ETF space. There's more than 900 ETFs listed on the Toronto Stock Exchange. You recently acquired ETF education site Verify. They run that big ETF exchange conference in Miami Beach that I go to every year. You go to as well. Tell us about this. What does TMX and the Toronto Stock Exchange get with this Verify acquisition? Why ETFs right now?
Well, thank you for starting with that, Bob, and thanks for having us for this today. I mean, you said it almost right in the question up front. We see the ETF, the exchange traded fund, as essentially one of the most important innovations in retail investing in the marketplace history, at least in the last 20, 30 years. And Toronto Stock Exchange was actually the original pioneer of the ETF more than 30 years ago. And so, as you mentioned, we've got almost 1,000 listed ETFs on exchange right now. And what we were really looking to do is, how do we get deeper into providing more support to our clients? So, more capabilities to the 40 ETF providers that are listed in Canada, more resources and capabilities into global ETF providers. And quite frankly, what Verify really does really well, index creation, so ETF providers can create new products, and great solutions so that they can reach a broader investing audience. So that's the 1-2 punch of what we were doing with that investment. And quite frankly, it serves another objective of TMX, which is to get more global. It's one of our stated objectives worldwide, is that we want to be more global than local. And this is a great asset to help us build, not just in the US, not just in Canada, but around the world.
Yeah, global reach seems to be the key story here. The ETF business, I've been covering it for 20 years. It's maturing a little bit here. It's $8 trillion in the United States. Most of the money still goes into essentially index funds. Where do you see the growth prospects for the ETF business in coming years?
Well, really see it in 3 places. So one, we are getting to a more mature stage, but I don't think we're there yet. Because when you think about the difference between both kind of where the ETF maturity is versus mutual funds, there's a lot of room to grow. And even I'm sure the US is a similar market in terms of the inflows and outflows. ETFs in Canada were up, 38 billion last year. Outflows of mutual funds were 57 the other way. But it's still only about 1/3 of the assets under management are in the ETF space versus the mutual fund space. So there's underlying growth still to go. There's underlying global development still to come, because as much as Canada and the US are more mature, other parts of the retail trading universe around the world are not there yet. So you've got that global growth as well. And then you layer in a couple of the pieces. More creativity coming from product manufacturers, so looking for more thematic indices where they can create that next alpha that gets investors excited. And quite frankly, more reach to end investors. So a lot of the fund manufacturers, they're not like the old mutual funds that had their own advisors. So they're still building in terms of their investor awareness. And as they do that, that's actually going to allow them to add more products like thematics, but also actively managed ETFs. So I still think there's a lot of creativity to come. And I mean, you mentioned the conference that we were both at. I'm a big believer that the next innovation was in the room, and we're going to hear coming out of that from the connections I've made, what are going to be some of the next great products that come out of this.
Speaking of next great products, I've got to ask you about Bitcoin. It's over $60,000. It seems to have moved up since the spot ETFs were approved here in the United States. But most people don't know this. You and the Toronto Exchange listed the first spot Bitcoin ETF. That was the Purpose Bitcoin ETF on the Toronto Exchange. That was back in 2021. So it took 3 years, but the U.S. finally got a spot Bitcoin ETFs in January. So describe the Canadian approach to crypto, and does it differ from the U.S. approach? You've been ahead of the game here on this.
Yeah, I'd say the approach and the products themselves are not materially different. The approach in going to market is probably where Canada is different, because our community is maybe tighter in terms of the relationships between both the manufacturers, the exchange, and even the regulators. We can work cooperatively on new products. So that's why you actually see a lot of the innovative ETF product often starts in Canada first. So even when you go back to the development of fixed income ETFs, they were launched in the Canadian market first before they became more prevalent in the US. And so if you look at both fixed income and crypto in that lens, what do they both do? The ETF actually provides a better tool for a retail investor to engage in a product like this than going at it directly through whatever over-the-counter market exists for them. And when you compare investing in the ETF versus investing in spot crypto, you've got more certainty as to who you invest with. You've got a regulatory framework around it, better disclosure, better liquidity to get in and out. So it's everything that improves the product for the retail investors. So by working with the manufacturer, working with the regulator, we were able to do that quicker. And I'm glad to see the U.S. has followed suit on it.
I would note that other companies in the United States have already filed for a spot Ether ETF. There are already Ether futures ETFs that trade here. But Canada, again, you already have a spot Ether ETF. It's the Purpose Ether ETF. You seem to be ahead of everybody on this. Do you see like ETFs for many different cryptocurrencies, or is there something particularly special about Bitcoin and Ether, and the other ones are sort of in a different category? I mean, what prevents anybody from doing, many different kinds of crypto ETFs?
I think at that point, it's really about scale. Like any other ETF, to be successful, you need to have enough of the underlying activity, the underlying asset, for it to be have that broader investor appeal. And that's probably the limiting factor on other currencies or tokens. But the product and the structure of the ETF would certainly allow for more products to be done. And as this market develops, you could see also indices being created of multiple types of assets that could be the benchmark for future ETFs as well, where you could have a basket. And that's exactly the kind of thing that VettaFi can help us do.
Yeah, we have that in the U.S. already here. Let me move on here. When I think of Canada, I think commodities. Energy and mining are a very large percentage of the Canadian economy, larger than the United States percentage. Over half of the publicly traded mining companies in the world list with you on the Toronto Exchange. And yet commodities in Canada have underperformed the U.S. market, I think because of the dominance of tech in the United States. Can you address that? How do you feel about commodities right now and its place in a portfolio?
Well, it's a good time to ask that question because we're coming right up on PDAC, which is the Prospectors and Developers Association conference. It's the biggest mining conference in the world. It's going to be coming to Canada shortly. And I do think there has been a timeline on bringing new investment into the space. It's been a little slow in the last couple of years as people are still figuring out what's the demand going to be for lithium, for cobalt, what's the permitting going to be to open up new mines and really provide the minerals that we need for transition. So that has, been a bit slow in terms of actually developing in Canada, in the US, and around the world. But when you look at the outlook on it, and you got the point exactly right, we've got over half the world's listed mining companies, and several hundred of them are actually engaged in kind of new economy mining as well. Again, these battery metals that we need for transition, that's all going to need financing. And we've also done, and historically, about 50% of the world's financing in the mining sector. So this is an area that, as the market heats up, if we see more certainty around investment, there's potential for a really interesting deal flow on financing these companies. And what you find is those companies that are getting financed in this market, they're developing properties around the world. So not restricted to Canadian assets. They are global businesses that list and raise capital here. Right.
So your strength is in mining, base metals, rare earth metals. This VettaFi deal seems to help you. You now also own the Alerian MLP index that you got from VettaFi. There's, of course, an ETF associated with this, the Alerian MLP ETF, which is pipelines, essentially. Tell us about that acquisition and what you want to do with that.
No, you're exactly right there. The other side of resources is in energy, and we're one of the largest energy markets as well. And so having that lens through the MLP market on having a really great product around energy, helps with the bona fides of our ability between TMX and VettaFi to create other energy-related indices in that space. And a little known fact on TMX is we also operate the largest energy market aggregator in the world. So that's our Trayport business. It's based in London. And it's actually the single screen if you want to see all the European energy markets, particularly gas and power, on a single screen so you can interact with that liquidity. You do it through a TMX property in Trayport. And we are, in part of our globalization strategy, we're actually working on developing that more into the U.S. market as well. So we have multiple pieces of our U.S. strategy of bringing more capabilities into that market, and automating trading around U.S. gas and power is one of those strategies we're working on currently.
And very briefly, I remember having a discussion with you a little while ago about essentially you have an incubator for small companies at the Toronto Stock Exchange. We're trying to figure out a way to get more companies to go public here, but you have a sort of an incubation process. Can you describe that to us briefly?
Yeah, and if you think about it from the outcome, last year there was so few IPOs anywhere in North America, yet we brought 25 new companies onto the senior market through that incubation regime. So we run the TSX Venture Exchange. It is a small cap market. In some cases, compared to the United States, you might even call it a micro cap market, where a company can raise public money at a very early stage, Series B, Series C, $5 million, $10 million, and then grow on the exchange, where they can come back and do cyclical re-raises as they build their business. And when they get to that size where they're senior market ready, we can graduate them up and give them that senior market exposure. So we've been doing this for 20 years between TSX Venture and TSX. We've graduated over 750 companies, so ones that we incubated ourselves on the junior market and brought to the senior market. And it's actually that unique structure of junior and senior was what makes the Canadian market different around the world. With that, we've been able to list almost 250 global companies that didn't have that same access to capital in their home market, and they come list with us in Canada to do that. We built all this out of the resource market. That's where it was originally designed, but it's worked really well for technology companies as well. So, resources, like you said, is the biggest sector, but the closest number two is technology, because a lot of technology companies are also multiple rounds of fundraising to build their businesses. So they can do that on the TSX Venture Exchange. And when they get scale, graduate up to the senior market, the TSX, and expand and grow.
Yeah. John, it's been a pleasure talking with you, and good luck with the Verify acquisition. I know all of those people, so we'll want to stay in close contact with you. Thanks again, John. John McKenzie is the CEO of TMX Group, which runs the Toronto Stock Exchange. I want to switch gears right now and talk about how one big registered investment advisor is using ETFs to invest in 2024. John Davi is the founder of Astoria Portfolio Advisors, an investment advisor business that uses ETFs almost exclusively. An old friend of mine, I've known him for many years. John, we were talking earlier, you say you are the most constructive you've been in 2 years on the stock market. Why?
Yeah. Well, if you think about the last 2 years, you've had to deal with Fed, hiking rates, rampant inflation, corporates that were preparing for this recession that didn't wind up happening. You had negative real interest rates. Fast forward now, the picture's dramatically changed, right? You've had now inflation come off quite a bit. You've had the Fed that is talking about cutting interest rates. Maybe it's not 6, maybe it's 3. If the economy is still strong, maybe you only get 2 or 1. And you have now profits recovery. So we just think now you want to be overweight equities. You want to tilt away from market cap weight indices. So we have a much more bullish picture on the market going into 2024.
Yeah, well, we got the reasons right here. All of this makes sense. The soft landing is certainly working right now. But you've been very big on quality for a long term. This is a word, quality, which has really come into vogue in the last 5 or 6 years. It's having a moment right now. Define what quality means to you. What are the characteristics of quality, and why have we determined that these are factors that drive out performance?
Okay, so quality would be companies that, let's say, have stable earnings, not a lot of volatility in their earnings. They pay dividends. The sustainability of their dividends is strong. They increase their earnings. I would say it's, blue chip companies, right? Companies that Warren Buffett would buy. So that's how we define quality, and we have like a very quantitative process for how we define it. As far as why I think it's working well, if you just look over the last 20, 30 years, MSCI has these factor indices. It is the most consistent factor compared to small caps, low volatility, growth, momentum, value. So it's the most consistent, the best risk-adjusted return. So, when we build portfolios for financial advisors, we don't want to be tactical, because I think you have to be tactical when you decide between value, small cap, growth, momentum. So quality is just much more consistent.
It's funny you mentioned Warren Buffett, because essentially what Warren Buffett turned into was a quality investor. Everyone knows Warren Buffett famously was under the influence of his mentors in the 1930s, Ben Graham, and he was a value guy, what they call cigar butt guys, picking poor companies that had underperformed off of the floor, essentially. And under the influence of Charlie Munger, he became essentially a quality investor, which you were talking about. Low debt to equity, high return on equity, earnings growth, for example. And so people essentially what's happened is the market, it's not that Buffett isn't a great stock picker, but he's employing a factor that people have determined is very important in outperformance. One of the only ones, as you mentioned, quality here. I want to move on here and talk about some other things. Let me just talk about where we are right now in the markets and what's been going on right now here. There are several ETFs that fit this description we're talking about, quality here. The biggest is the iShares Quality ETF. That's QUAL. That's been really neck and neck with the S&P 500 in the past year. And again, if you look at what's in quality, what is it? In these screens that show up, QAL, it's essentially big tech names. You see how close they are too, but those the S&P 500 versus QUAL. That's the blue line, QUAL, the ETF. So it's close. But essentially, if you put up what the biggest holdings are, thank you, here are NVIDIA, Visa, Meta, Microsoft, MasterCard. We talk about these names all the time. They've been hitting new highs regularly. I keep putting up Visa, MasterCard outside of the Magnificent Seven. Visa, MasterCard, Amex, and JP Morgan, which show up on these things, are the big ones. So quality seems to matter at this point of these characteristics right now.
I would point out that NVIDIA wasn't always a top holder. They were balanced last year into it. Home Depot was a top stock, so there is a rebalance in there. The stocks do change, so it's a little different from like a SPY ETF, but it is optimized against the MSCI USA index. So it is meant for like an advisor that wants S&P-like returns with like, let's say, some overlay to the quality factor with the alpha signal that MSCI in conjunction with BlackRock is going to create.
You've got your own ETF. Everybody does these days. The Astoria U.S. Quality Kings ETF. ROE, get it? Return on equity. ROE, put that up there. But that's underperformed the S&P 500. But importantly, this is an equal weight, not a market cap weighted ETF. And I just want to show what's in it, how different this is. The other one, NVIDIA's here, but you've got Lilly, which has been a great performer, by the way, in healthcare. Lam Research, Cigna, which has been a great performer in financials as well. But you see, it's equal weighted here, so you don't get this kind of heavy weighting towards a small group of stocks. Now, why is it equal weighted?
Why is it equal weighted? Okay, so good question. So it's equally weighted because we just think when you build a portfolio, you shouldn't. Right now, if you buy SPY, it's a very defensive strategy. 7 stocks make up 30%. Okay. And I just think that you are somewhat defensive and bearish if you were just leaning in on market cap weighting at the current moment. So last year, we started to become uncomfortable with the exposures that some of these market cap weighted indices and smart beta products like Qual was giving us. So we said, look, we want to have a component of it towards equally weighted. So we prefer like a third market cap weighted, a third equally weighted, and a third, let's say, some other quant metric smart beta weighted. As far as why we made our product equally weighted, if you just look over time, equally weighted indices outperform market cap weighted. But yes, over time, so the S&P, long time, there's periods where market cap will do better, equally weight do better. But as a long-term investor that's trying to be diversified right now, because I think you have a lot of concentration risk issues in SPY, we just wanted to make it equally weighted.
So why do you think, I'm always curious about this, in the past, it used to be the biggest determinant of outperformance was beta, how sensitive it is a stock to movement against the S&P 500. But why is quality won out? I mean, remember there were plenty of theories going back decades that value would outperform growth over the long term, or small caps would outperform big caps over the long term. Most people still believe that. But those two factors haven't worked as well. I mean, big caps have outperformed small caps, and growth has outperformed value for essentially more than a decade, with maybe 2022 is the exception. Why? Is there something? I'm trying to figure out what's changed here, if there is anything that's changed, or maybe we're just due for a mean reversion.
Yeah, I think that, so for me, growth and value is tied to like the economic recovery, the profits recovery. When you get a profit cycle increase or decrease, that's when growth and value would work. For small caps, I think right now, it is about interest rates. And I think, when you go from 0 to 5.5%, that puts so much pressure on small caps.
But that happened recently. Small caps have been underperforming before that.
Sure, that is true. I would say that the proliferation of ETFs, people can just, it's just easier to buy SPY. It works well over, long periods of time. some of it is active to passive debate.
Yeah. The value guys have had a tough time. We had Howard Marks here, a man I greatly admire. I have been reading his stuff for years and years, and yet they've been having a tough time of it recently. Value's really had a tough time, and the small cap value, in theory, you combine the two, should outperform long-term everything, and it hasn't for a while.
Yeah, there's an argument that you need, decades and decades. That's like long term.
It's a long time
we live in a world where
30 years is a long time to wait.
Yeah, but I would say that if I'm, kind of investing for 20, 30 years, again, that's part of the reason why we wanted to equal weight ROE, because we do think over periods of time, you are making a bet on mid cap when you equally weight. I would say value and growth, it is such a big concentration of sector differences at the moment. Yeah. Tech and growth.
But the big keep getting bigger. I mean, you want to talk about equal weight versus market cap weight. So in the last decade, I looked at the RSP, the equal weight ETF, against the S&P 500 market cap, and it's still, the RSP still underperforms. There's the numbers there. You can see the chart. And it's not far apart, and past the pandemic, as you got into 2021, you saw that's the orange line is the S&P 500, and that's tech. As tech kind of pulled away and became more dominant, equal weight had a tougher time. It's not a terrible underperformance for equal weight, but it's still there. And something has happened since then where tech has become predominant. And I mean tech, I mean communication services and technology.
Yeah, I mean, these companies are no doubt NVIDIA, Microsoft, Apple.
So is that it? It's that simple. It's a paradigm shift. It's sort of the AI play to a certain extent. But this was happening before AI even.
Yeah. I wouldn't be underweight tech or growth anymore. And those equal weighted indices, you only get 15% tech exposure. S&P is closer to 30. So again, that's why we wanted to optimize against the S&P sector weight. What I would say is that diversification, right? If I was an active manager, Howard Marks, and somebody at Howard Marks' firm had the S&P concentration risk in his portfolio, I'm pretty sure that the risk management department would come knocking on the door. So again, we just think you should own a couple different verticals, market cap, equal weight, and some quant weight.
It's certainly a good risk diversifier. I don't have any problems with that. I have no problem with the idea and the theory behind it. I just have a problem with that it's been underperforming for a while, and I keep waiting for this mean reversion because I'm an old Eugene Fama, acolyte too. I feel the same way. In the long run, there should be some mean reversion here. But something's happening. There's some kind of paradigm shift. Maybe partly this is the AI story, just like internet was the paradigm shift in the 90s, and it kind of changed valuations dramatically. That may be as simple as that.
And they're not that expensive too, right? Like the S&P, it's only 20 times earnings. NVIDIA, I mean, some of these companies are just not that expensive compared to the internet era.
All right, John, always a pleasure to see you.
Thank you.
Thanks very much. John Davies with Astoria Portfolio Advisors. That does it for this week's ETF Edge. My thanks to both Johns. By the way, we've asked John Davies to stick around, provide me some additional perspective on ETF trends for our ETF Edge podcast that's coming up. And remember, you can see all of our shows on our website. That's etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.